I convene the March 9th, 2026 Finance Committee meeting to order at 7:30 PM. Jackie, please call the roll.
Debbie Bryan,
Here.
Emily Swistack,
Here.
Josh Martin,
Here.
Liz Sullivan,
Here.
Tatiana Weinstein,
Here.
Will Savage.
Here.
Okay, agenda item 2 is the opportunity for visitors to speak. Public comment is for the general public to address the board. Each person will have up to 5 minutes to provide public comment. Okay, seeing none, we'll move on to agenda item 3, which is to approve the minutes of the January 24th, 2025 Finance Committee meeting. May I have a motion and a second?
I move to approve the minutes of the January 4th, 2025 Finance Committee meeting.
I'll second.
Okay, is there any discussion? Okay, Jackie, will you call the roll, please?
Debbie Bryan,
Aye.
Emily Swistack,
Aye.
Josh Martin,
Aye.
Liz Sullivan.
Aye.
Okay, now on to agenda item 4. That is the Lisle Library District Portfolio Presentation, Economic Update, Draft of the 10-year Cash Flow and Monthly Expenditure Sample. Investment Advisor Tammy Olszewski is here remotely from Ellers, and she will walk us through her presentation. Mark Rogers is also present to answer any questions about our facility projects.
Okay, on to you, Tammy.
Great, thank you guys for the time. I have a presentation, and Tatiana, I should have asked, is that up on a screen somewhere, or
No.
should I just share that? Okay,
Yeah, do you mind sharing it?
okay. Nope, totally fine.
We have
I just wanted
paper,
to be sure.
we have paper copies, so I didn't know if you wanted to like show.
Oh.
Yeah.
Got it. Well, let's see here. Alright. So what I'm going to do, I have a couple of pages here that I might go in between. So if for some reason anyone has a question along the way, or if I go too fast, just stop me. But about once or twice a year, we like to make sure that the Finance Committee is well aware of what is going on from an economic perspective that may impact the library's investment portfolio, as well as perhaps decisions that you are making as far as projects or operational staffing, things that, don't come up day to day, but in any case, we like to make sure you're well aware of what our perceptions are of what are going on. So many of you are likely hearing in the news, maybe not, but for the most part, everyone's probably hearing about some of the global effects of between the decisions being made by our current administration, as well as the constant argument of whether the Fed funds rate should be lowered. So those are two hot topics right now that are likely going to impact investment rates, as well as if you are trying to make decisions on projects or when to start them or things of that nature. So one of the common questions I get asked is, what does that really mean to municipal investors like yourselves? And as we are seeing interest rates have steadily declined over the last year, as we had somewhat expected, and now we're really witnessing a little bit of a shift. And what I mean by that is there is a lot of uncertainty in the current investment markets, or the global markets, really, when it comes down to interest rates. We see cash rates stay elevated when there's uncertainty. So we are hearing, based upon economic factors, we're hearing that there likely will not be a Fed funds rate decrease as soon as we had expected. So that changes on a regular basis. Right now, we're about a 90% chance, based upon futures interest contracts, of a Fed rate remaining the same. And we'll go into a little bit more detail there over the next few slides. But for your benefit, rates have started to come down. They have not as dramatically shifted on the short term, or the short end of the spectrum, or the yield curve. So this page that I'm showing now is really just representative of U.S. Treasury averages as of last week. So if you take a peek at the March to February, that month-over-month change, the 1 month, 3 month, and 1 year, there's a little bit of a difference there, but it's not dramatic. If we look a year ago, it's 60 basis points of a change. So that's really the blue and orange line are the current rates. The green line represents about a year ago. So you'll see that pretty dramatic shift on that short term. So anything that's 3 years or less has really come down pretty dramatically. And then oddly enough, the longer term rates, 10-year Treasury has held steady around 4%. 7-year actually increased this week as compared to last week. So Again, a lot of this we don't expect to change dramatically, but for purposes of your reinvestments and especially this cash flow that we're going to talk about in a moment, we are keeping an eye on rates and especially that Fed funds change, because if that rate comes down, you'll see your cash rates decline quickly. The 3-month treasury bill and the Illinois funds actually tend to track pretty close to the Fed funds rate. So we do monitor that rate on a regular basis, trying to, we never make interest rate assumptions, if you will, or gambles, but in any case, we do expect those to come down, and we're just trying to make important decisions now based upon the data that we have. One of the charts that we often look at that next page here is the forward rate sheet. This is really, it's observable market data. Oftentimes I will tell people it is based upon like futures contracts. So people who are gambling on interest rates, this is really representative of where they think interest rates will go. So that green line is where we expect rates to trend in the next few years here. And that blue and orange line is really representative of now, and then what we think 3 months is going to look like. So as you can tell, there's not much expectation in the gamblers of the interest rate market that rates will change. So all of that to say that Fed funds rate that we are looking at on this next chart is at 3.5 to 3.75. This is really a liquidity rate. It is a rate that banks borrow to each other overnight. So when you're thinking about interest rate markets in general, this is oftentimes one of the first things that people are checking. The next meeting is actually coming up in a couple weeks here, and there is no expectation for a rate change at this time. That has shifted dramatically since we, I would say probably early January, we had expected 3 or 4 rate cuts this year, and now we expect maybe 2 later in the year. And of course, all of that might change. So the only thing that you'll hear me say with any level of certainty is rates may change. So that's my prognostication for the night. But a couple of pieces of information that will drive the Fed funds rate. Oftentimes you'll hear the inflation rate. The target is 2%. We are not there. It certainly has not come down as quickly as I would say that they would like to see. Unemployment, same thing. We are not seeing anything too dramatic from a month-by-month standpoint, but there certainly is still unemployment concerns in the market. So those 2 factors are oftentimes driving that Fed funds rate changes, or when those board of governors get together and decide if they should or shouldn't change rates, that's detail that they're looking at. So if you're at the grocery store or out in the wild and somebody has questions for you about what's going on in the market, you can tell them rates may change. So any questions on some of those economic slides? We do put a lot of data in there, but I know most of you are probably most concerned about just in general where rates are. Otherwise, we can kind of move on to the portfolio itself.
That's fine.
Good. And of course, if questions come up, if something that I said earlier makes sense later, or if you have questions, just let me know. This portfolio, as a reminder, is really designed to preserve that principal. So the funds that you have invested, the typical investment vehicles are very low risk investments that either carry some semblance of a guarantee or an insurance policy like FDIC insurance or NCUA insurance. U.S. Treasuries, for example, carry the full faith and credit of the U.S. government. There are some government agencies which have full faith and credit, but there are some that have an implied guarantee. So we do check across the portfolio for those type of investments, and the entire goal is safety of principal. We are also very closely monitoring your liquidity profile. As we had very elevated cash rates over the last couple of years, it was not harmful to hold on to liquidity. In fact, everybody was a money manager the last couple of years. You could have put it at your bank really anywhere and you would have had 4 to 5% of interest earnings. So now we need to be a little bit more strategic, especially considering your projects that you have planned. We want to be mindful that you have operational cash flow when needed, but also enough to cover these projects with the goal of not issuing any additional debt, right? So not putting the library into harm's way, not setting down your cash too quickly, but also not issuing debt. The yield, of course, I always say that that's the last thing that we consider. Yes, we want you to earn a market rate of return and to be competitive, but really the primary goal is that preservation of principal and operational liquidity factors. The portfolio right now, just so that you are all aware, this page is actually just a summary that we provide to the library district. It really factors in your current holdings as well as projected income over the next 12 months. Don't panic. I assure you there's income on the portfolio. This report is just very It's a very basic report, so it does not factor out any projections on municipal money markets. So you are actually seeing a zero rate there, but you do have income of about $8,600 that will come based upon a couple of smaller holdings in the portfolio. As I mentioned before, we were waiting to deploy much of a fixed rate strategy until we had this conversation, just as we were going through the project planning and trying to make a plan for reinvestment strategy over the next 12 to 24 months. And then, of course, we have your 10-year capital improvement plan that we are basing some of these assumptions on as well. So you will see right now the holdings in the portfolio and the average that we have seen in the portfolio on the cost, or what you have paid for investments and earned, a little over 4%. So you're right on track with market rates of return. The goal, of course, now is to reduce that liquidity profile and build an investment strategy that will provide you that predictability of income, while also making sure you have cash needed for those projects and operational cash flow. The first page, and this could look really small on the screen, so I believe you guys have the investment plan itself, which will showcase that forecast over the next, this is through 2034, but we really kind of built it off of a 10-year plan. This really is just a showcase for you that based upon some very, very conservative assumptions. So to give you an idea, we assumed about 1.5% in interest earnings annually. That's certainly not where we're at right now, but the reason we assumed 1.5% is in the event something changed in your cash profile and we needed to adjust quickly, we want to be sure that you are not baking on 3 or 4% and then having to adjust and find a quick way to cover expenses. So really the 1.5% over this long of a period is conservative, but just know that that's what it's based off of. We also assumed about 4% growth when we are looking at the different assumptions of expenditures as well as revenue. So all of that to say, those numbers we kept about the same, or what we're seeing on par for other municipal governments across Wisconsin and Illinois. That also could change. So all of these numbers are really dependent upon market conditions, factors that are out of your control, such as reinvestment rates or cash rates, but also you never know if there will be tax law changes in this next 10-year period. You don't know if there will be revenue changes. So again, all of this to just build a very conservative estimate for you so that as we make these reinvestment recommendations, you can sit back and say, okay, that's great. We're not worried about cash flow. That's all that this was meant for. So you can see here, we expect in this, I should also point out, this factors in the Ellers investment account, your NOW account, or your checking account basically, and then you also have some other funds that are available to you that are liquid. So we really did factor in all of your actual cash flow when we built this.
Right.
So when I am talking about certain interest earnings, it is not based upon what we actually expect you to earn. It's really just kind of a holding place for your cash. So really all this did was showcase for us that even assuming your operational cash flows or your expenses, assuming a pretty consistent revenue stream and the interest earnings that we are predicting, the library will have plenty of remaining funds, and we don't expect a significant decline in those actual ending assets. So those forecasted total assets really represent, on the top here, the lot development as well as the project that is expected for the outdoor learning space or the outdoor project space. And then it, of course, showcases your expenses and predictable revenue as well as that ending balance. So all of that to show we don't think that you're ever going to go any lower than you are right now. So we have some growth built into these projections that you can plan for that predictability of income, but you also don't have to spend any one account down to nothing. So you have plenty of funds over the next 10 years to go through your project according to some of the loose schedules we have now. Certainly this may change if you accelerate certain portions of projects, or if your 10-year CIP ends up having to get crammed into 5 years. So there are certainly some maintenance concerns if you don't plan for things in the right time or the right year, which is hard to do. You don't know when certain electrical equipment or heating and HVAC equipment will go out. Those are factors that we can't control, but one of the best ways to do that is to actually have a solid plan in place, which you guys do have that 10-year plan. And really, this is all of this to just showcase for you that we expect you to be just fine, and we will build reinvestment strategies around these particular project dates and potential future capital improvement plans. So really, that's our goal for tonight, just to keep an eye on the Fed funds rates, reduce liquidity when possible, and what I mean by that is I don't know that I would hold on to too much in the Illinois funds or money market funds for these longer term projects, but they're certainly currently elevated. I mean, short-term rates are still over 3.5%, 3.6% for the most part, so you're not in a bad spot. I would suggest if rates continue to decline, or if we see a shift, or if somebody decides that interest rates have to come down at the Fed funds level, that is really where we would deploy even shorter term strategy on liquidity. But for the most part, we're recommending some of these reinvestments over the next 5 to 7 years, just to lock in some predictability and yield for those projects. And that is all I have for you guys. So I will open it up for some questions. I covered a lot of details. But again, really, this was, the goal of this was to make sure you know your funds are safe, they're sufficiently liquid, and it sounds to me, and really, it wasn't just me, it was also my portfolio analyst. We went through a few different scenarios, but you guys should be sufficiently liquid and prepared for a couple of the projects that you have on your plate coming up.
Tammy, can you bring back, slide 10?
Of course.
Okay, does anybody have any questions about this slide, just right now? Cause I wanna bring Mark into this. Can you bring out your sheet that looks like this with the multicolored project sheet? You don't have this, I mean, I think you have this, Tammy.
Oh, I do, yep.
Yeah.
And I think we actually built this page that I have up, which was really just we went through year by year for visibility purposes, but this of course goes through month by month as well. So this really showcases for you these expense estimates that we have over the next few years here.
I'm talking about the actual projects, the Excel, I don't know if you can see my page here.
Oh, yeah, we have that.
one, yeah.
I didn't have it open.
That's okay.
But no,
If you can bring up, slide 10, and then Mark, could you
Yep.
go over this?
Sure, and how it all plays together.
Yeah,
Yeah, I think, and Will helped out a lot with this. We'd come up with a comprehensive list of items that we wanted to look at over the next 10 years. Some of those items are gonna be like painting and things like that, wouldn't show up on here. That's kind of in general, just over time, we're gonna do some maintenance. From talking to Will and Tatiana, this is more the large capital expenditures that you'd anticipate, having to replace a boiler, having to replace a roof, things of that nature. And you can actually see, and we'll tie it back to what Eller's put together here in the years. There's a few years where you're actually looking at total expenditures being in excess of operating receipts, and the reason being, 26 and 27, that would be for the lot development primarily. Then you look into 29, just to put a blanket over it, it's a roof project in 29. In 30, it would basically be a boiler amongst a couple little miscellaneous items, being like the server room split system. So it's a buildup of a few kind of HVAC-ish type items. And then 2032 being a window project. So there's a number of potentially larger capital expenditures over this 10-year plan that is baked in, and looking at Eller's information, it matches. One other thing I'll point out, and something that Will brought to my attention too, the lot development number. If you look at those two numbers, when we last presented to the board, I want to say a couple of months ago, that number all-in project was 1.25. What this is because we wanted to be ultra conservative for your 10-year cash flow, that we actually have a 20% cushion, I'll call it, for everything. So that's why that number looks a bit different. And I think that was wise that Will had said, no, let's leave it in there. So that way, it's a cushion. If something else were to happen, that just falls into something else. We would not anticipate having to spend that on the lot project, but maybe there's something else that happens. Now you've cushion.
and, Tammy, can you talk about the ending asset balance, for each year? This is the ending asset balance for the end of the fiscal year, correct?
Correct, yep. So we factor in when we build this. In fact, let me grab this sheet here. Oops. And this is just a little bit different view of that existing data, but it really bases your beginning asset balance. It looks at any projected inflows, outflows. There's an asset return of that 1.5% as I suggested. And then of course we have those project expenses. And when we look across this, there we go. Made it a little too large for the page here. That's really where we get that ending asset balance. So we actually have this trailing over the each month by month. So you'll see there are a few months where you get below kind of that low point, you're at about 3.6, but that end of fiscal year ends up, you still end up well within the reasonable amount, I would say, of spend down for your fund balances. So you really, the lowest point is 3.3 million.
But,
And that's of course between now and 2027.
and this 400,000 that you're seeing repeated, that is something that Jackie, I, and Will looked at as like a monthly expenditure, and that is well beyond what we spend on a monthly basis.
And the goal, of course, would be to alleviate spending any one account down to nothing. We do want to ensure that there's still that predictability of income, which will help replace some of these expenses each year. And certainly some of these years, these expenses will be covered by interest income. That's really the differentiator as well.
I thought it was interesting too, I pointed out like 5 years where your expenses might have been larger than your receipts, but if you look at the actual ending asset balance, there's only 2 years where it actually goes down because of the way it's all structured. So it's really, it's the year with the roof and the year with the windows that there's actually an impact on the ending asset balance.
Right.
And that year could change depending on when we need those
Yeah,
Right.
replacements.
roofs really, you can extend, you can spot repair if they're not leaking, just, you can keep on going with those types of things. You will need to do it at some point, so that's why you wanna make sure it's in there at least. Same thing with windows, and you might just end up looking at sealant and things like that instead of full-on replacement, those types of things you can play with.
Any other questions for Tammy? Does anything not make sense, or do you need more explanation on the charts?
More of a general question. And I know you alluded to this at the very beginning, Tammy, but what's the general consensus from financial experts on what the next, we'll call it 9 months, hold for the rest of 2026? I'm thinking we're not looking at tremendous returns or, terrible interest rate increases, but there is a lot of uncertainty. What, if anything, are some of the silver linings, hedges against that, so that it's not a, my concern, these numbers all make sense, but these numbers make sense today. The question is, do they continue making sense 3, 4, 6, 8 months from now?
No, that's a good question, and I did not bring my magic 8 ball.
Yeah,
so
I know. Too bad.
Is that
But
today or
no,
tomorrow?
in all reality, there are a lot of uncertainties in the interest rate market.
Yeah.
The economic indicators that most experts or individuals in our roles use, they're just not as relevant now as they were in 2008 or in 2016 and in 2020. There were things that were very predictable. Economic cycles were following trends, and the joke in the industry is, you can't base future performance on historical performance, but there are trends that tend to, economic indicators that tend to send a red flag, right? And right now, the unfortunate situation that we are in, not only with the really going basically to war again with Iran, unfortunately puts us in a completely unique situation as compared to where we had thought we would be 3 months ago. So if you had asked that question in January, I would have said, hey, based upon the interest rate market and some of the trends we're seeing, we expect the short-term cash rates to start declining. We had started to see longer-term rates bump up just slightly, and we still see that on a week-to-week basis. Last week, for example, the 10-year Treasury was 4%, and now it's 4.15, which doesn't sound like a big, exciting change, but that's a pretty significant shift when we are thinking that rates are coming down and the long-term rates are actually going up. All of that to say that is some normalization of the yield curve, and what that means for an investor such as yourself is we are seeing that as a triggering opportunity to lock in some yield across the next few years so that you don't have that uncertainty. One of the few hedges that you have against interest rate uncertainty and some of the impacts of the global market is fixed rate. So fixed income, the downside that you have is if rates were to shoot up suddenly, you might be holding a 3-year at 3.5%, and the 3-year may go to 4 or 5%. So that is certainly a potential. And do I think it's gonna happen? Probably not. Do I think that there will be some rates that will shift upwards? I hope so. But the reality is, we don't expect a dramatic change in the next 3, 6, 9 months. The largest change that we expect to see is if the Fed funds rate comes down, shorter term cash rates are expected to follow suit.
Okay, thank you.
And I think that's why we
That
went
was a
super
long way of
conservative.
saying,
Yeah,
yeah, rates may change.
yeah,
Right.
Tammy, as a stress test, if rates were to change by 1/4% or something like that, down or up, what substantially changes in the investment management plan that you have up there? And is it really, we're talking, $10,000 delta in Eller's account and now account anyway? So we're not talking big money, even if that does change by a
Yeah.
quarter amount, half percent even. And we're talking,
And
what
it's
range are we
not a
talking?
significant amount, yeah. It really isn't. And when we start looking across, the portfolio between the 3 kind of liquid or investment accounts that you have, we expect there to be that $60,000 to $100,000 of interest every year. And that is the one part that might change. The actual holdings themselves, we will see some unrealized shifts, but traditionally in the actual projections that we built it on 1.5% as an average. So even if rates drop to, I think that 2019 rates were 2.5% in most cash products, and we were all very excited. And in 2020, they went to 0. So that impacted a lot of our investment portfolios in the sense that anyone who was holding onto too much liquidity for too long really couldn't bank on that interest income they had planned for. So our goal with all of this type of long-range planning is to have a very conservative outlook. So even if you were to lock half of your portfolio into 3.5% or 4% interest, and then the rest of it ends up falling victim to short-term cash decline, you still have a nice average that should put you into a comfortable position regardless of interest rate shifts.
okay.
Any other questions for Tammy? No? No. Okay.
All right,
Thank you
well,
so much,
thank you so much for the time, and if you have questions that come up after I jump off, I'm always available to you, so enjoy your evening, and thank you again for the time.
Thank you,
Thank you.
Tammy.
Thank you. Thank you.
Bye, guys.
Bye. So, as far as the projects go, can you give a little bit of a, now that we've heard from, as far as if we were to move forward with what we planned, it seems like we have healthy funds to be able to manage it on our own. And maybe it's in the chart, but as far as like payouts for project
Yeah.
work, like how does that?
Yeah, we'd want to rebuild the schedule and make sure that we're working with you in that schedule, because we're sitting here in March. I think a typical time frame, if we wanted to make sure there's enough time for your review, the administrative review of drawings and details. We know what this plan roughly is going to be, which is great for budgeting, but we still have a lot of detail to go in. You could say, okay, we want to rush and try to get, dirt moving this year. There's pros and cons to that. I think you might short circuit some of the reviews that you all might want to do. It might be in a situation where, let's get the design done so we can go out to bid this year, meaning that you're actually putting real, moving dirt in the spring, March, April, something like that next year. So it's really how fast we want to move, because if you move faster, you might lose some time for review, and you're going to get stopped by winter weather anyways. And where do we bridge that? So if that were the case where you said, okay, we want to go methodical, we want to get them right amount of time for review, and go out to bid, say in the fall, I think the fall's about right, October-ish, November, something like that. At that point, you'll be able to sign a contract with the contractor, hopefully by December, New Year, something like that, get them ready to mobilize in March. You have a long runway there, and you have some leeway. What that means is you're not putting most of your expendables into this year, putting into next year. I think from memory, the architect's professional fees on this, my face don't say the wrong number, but they were, all in for professional service costs, we had $190K. So, it's just a crude way to look at it is, would you expend that much this year? I think, we were looking at this as, how do you split this up between when 2025 ends, 26 starts, And we had front-loaded it originally to be more conservative, to say, okay, you know what, let's, as soon as we get the grant, how does it, we can put it all into this year. If you push it out a little bit, that's not going to hurt anything depending on what the library wants to do. Can you get something moving and then, you know, dirt moving this year? Yes, but it's really a judgment call on how fast you want to move and how much time you want. You know, are we gonna come back to you every board meeting and say, here's the update, what do you think, and change it, tweak it, whatever else, or even every couple months? That type of cadence might be more appropriate, in all honesty. I think what we showed you from Tammy's perspective is a more conservative approach of front-loading it, which is always how we cash flow anyways, we front-load, that way you know you have the money and then expend a little bit later. Is that what you're looking for?
Yeah.
What's the overall consensus on what, like, materials and finished goods prices are gonna do over the next 12 months? Do you have that forecast?
Yeah, we're not seeing a huge expectation and jump right now.
Okay, that's fine.
Interestingly, we've opened 3 bids in the past month, and those are all projects that are, they have the contractors are projecting out about 18 months, they're about 18-month builds. They're actually coming in at budget or even a little bit lower than budget. Not much, but a little bit lower. Depending on-
Yeah,
So
that's
people are
good.
hungry. We were worried about electrical, for instance, you don't have
Yeah.
much electrical in here.
Yes.
Electrical was high,
It's true.
but some of the other trades came down low. So we're seeing certain trades hitting harder, but things that are not really impacting you. Electrical is definitely one I'm worried about.
Right.
HVAC to some degree, I'm worried about. Earthwork and things like that, I haven't seen any real major
Right.
concerns.
Okay, that makes
Great.
sense. All right, well, that's good to know.
So don't add a bunch of electrical on this, but.
Not planning on it.
You know,
Some.
lighting over
There'd be
there.
some, yeah.
Right, yeah.
That's expected, yeah, and budgeted for.
There's not a bunch of outlets at every,
Right.
you know, light post,
Yeah,
right?
all the crazy
exactly,
light
yeah.
fixtures and everything else.
Yeah, yeah, no, it's all good.
Electrical switch gear, things like that.
Yeah.
That's what's really driving things right now.
Got it. Okay.
Does the committee feel good about moving something forward to the board and giving a recommendation of moving forward with the project, or after seeing these numbers?
I do, I think that it looks good, I feel like we're confident in
I
in
agree.
it, right? I mean, and again, taking a conservative approach as we go, you know, in case, I mean, even if we spend the rest of the year getting bids, I mean, we're not jumping off, you know, and maybe by next year, the unpredictability feel will be less, or
We'll see.
or, you know, whatever, but I mean, you know, we're not doing anything crazy, right off the bat. I think it's good, and I think it's actually a good use of dollars, you know, as a, you know, taxpayer, you know, you want your money being used, I mean, we don't want it all just
Yeah.
being saved up, right, you
That's-
know, and so, I mean, I do think that, you know, we can show our constituents that we're, you know, continuing to work and make, you know, use the money to make improvements. I think that's part of it. So,
Yeah, the fund balances are pretty substantial,
Mhm.
so I mean,
yeah,
never, in the next, basically 3 years, not seeing a dip below 3 million is very reassuring, so.
Yeah, we worked with Tammy on all of the funds we have that are invested, like all across the board, not just our operational fund balance.
Right.
So
Yeah.
this will mean, Jackie and I will look over the smaller funds, she had mentioned like Illinois funds or
Mhm.
some other smaller funds, and possibly reinvesting those into something that's better, but,
Yeah.
just knowing that the committee is comfortable,
Mhm.
we can present something to the full board and get their opinions.
absolutely.
I think it's helpful to know this also
Mhm.
coming out of not being awarded the grant. I think it feels better to know that we're okay.
Right,
Yeah.
right, yeah.
We're okay.
We don't have to do it in phases or anything, absolutely.
Yeah.
No, I think that's
And we
good.
still, I mean, with everything, we would still have a healthy amount in operational reserves if we
Right.
ever needed to dip into that.
Right, right.
The other piece I'll mention is because this would be not regular operating fund, we would need to move some funds into our
Right.
special reserve. So that will happen in the budgeting process.
Right.
Okay.
Right. What is the balance of the other funds? Do you know that?
It's on here, it's that consolidated amount. Let me find it.
Remaining
It says remaining accounts. it says now
Oh,
account,
yeah.
teller's
Oh.
account, and then remaining.
Remaining.
Oh, so
Okay.
that, got
Those
it.
are all chopped up.
I see, that's,
Okay.
that's what that means,
Gotcha.
I understand.
Gotcha.
Okay, got it. So this is the full amount,
Every-
so the Illinois account is included in remaining
Right.
accounts?
Yes.
Right.
Understood,
Yeah.
okay.
So, and you manage the remaining accounts?
We,
Yeah,
we
yeah, you
all do,
in-house, yeah, okay,
and
got
then,
it.
like, some are at Lisle Savings
Mhm.
Bank,
Got
some are
it.
at Illinois
Okay.
funds.
Gotcha.
Yeah.
Oh, I understand, got it, okay.
I also think knowing what's coming down the pike, we have kind of till 2029 or,
Yeah.
maybe 2030, before we have another big expenditure coming, so this is the time to do it,
I think you're right on that.
So it's great to have this 10-year plan and kind of have some
Yep.
numbers so we know what we're facing.
Yep, agreed.
Do you do this for my household budget, please? Help me know.
Mine too.
Yeah, right? When can I really retire, Mark? Yeah.
Still waiting on the tankless water heater at my household, so yeah.
I did that, never looked back.
Oh, really? I'm halfway through. I think,
Well,
yeah, you just wanted to make sure that we had kind of consensus. I think we've got Tara still waiting kind of in the wings. We haven't really gone back to them to say one thing or another, so we can always go back to them around the next board meeting and say, okay, this is,
Next week,
Yeah.
Next
the
week,
board
yeah, that's
packet is
true.
actually due this week.
yeah, so we can go back to them and just say, we're still
Yeah.
thinking about it, and that would be the next step. If the board wants to move forward with something, it'd be
Uh-huh.
going and say, okay, do we approve Tara
In April, maybe.
in April? So that maybe
Okay.
where we go from there, and then that gives you that 6 months or so, October, like I mentioned, that gets you about the right time for bid. Also might answer some of the volatility questions by then. Maybe.
Hopefully.
We hope.
Hopefully.
Until the next thing.
Yeah, well,
Whatever that
yeah,
is.
we'll see. Okay.
Okay,
Sounds like a plan.
great.
good.
Okay, do we have anything else?
No, I think it's very good,
No?
sound, good
Okay,
decision.
very good. Well, may I have a motion to adjourn?
I'll move to adjourn.
I'll
And a
s-
second.
I'll second.
Okay. Roll call, please, Jackie.
Debbie Bryan,
Yes, aye.
Louis
Sorry.
Swedek,
Aye.
Josh Martin.
Aye.
Liz Sullivan.
Aye.
Okay, and we are adjourned at 8:07 PM.
Nice.